Good morning, everyone. Thank you for joining us for today's webcast, What is Life After Coronavirus? Navigating PPP Forgiveness and Certificate Guidance, presented by Rea Associates, a top 100 regional CPA and business consulting firm with offices across Ohio. My name is Imani Fields, and I'll be moderating today's presentation. Before we get started, there are a few housekeeping items to cover. First, if you have any questions during today's presentation, you may enter them into the chat box on your screen. We will be working to respond to as many questions during today's presentation as possible. Any questions we did not answer during the webcast, please reach out to us at reanews@reacpa.com, and we will respond to your email at the conclusion of today's presentation as soon as we can. If you registered for today's webcast, you will also receive the recording of today's presentation, as well as a link to participate in a very short evaluation. Please take a few minutes to share your thoughts about the presentation as a whole, the information provided, and the presenters. Your feedback is important to us as we determine future webinar topics. Also, if you'd like a copy of today's slides, you'll find that they're available in the handout section of the webinar dashboard on your computer screen. Today's webcast will be given by Doug Hauser and Paul McEwan. Paul McEwan is a principal at Rea Associates, where he leads the firm's retirement plan consulting and administration services team. He is responsible for consulting with clients on fiduciary best practices related to their qualified retirement plans. With more than 30 years of accounting industry experience, his areas of expertise include retirement planning, fiduciary issues, plan compliance, and reporting issues. As the principal and director of construction and real estate services at Rea Associates, Doug Hauser is committed to building out and growing the construction and real estate services segment while continuing to ensure that they are known industry-wide. Doug has more than 25 years in the accounting industry, and his areas of expertise include financing structures, cash flow management, balance sheet management, succession/exit planning, and long-term capital liquidity event guidance. Today, Paul and Doug will discuss updates on how to navigate the PPP Loan Forgiveness and Main Street lending programs and additional guidance amid the COVID-19 crisis. And I'm going to pass it on to you, Doug.
Thank you very much, Imani, for that wonderful introduction. And Paul and I are glad to be with you again this morning. I imagine for many of you, it's getting to be old hat and seeing our faces. So hopefully that's not too annoying for you. But today we want to spend a lot of time just covering some of the questions that we continue to get over and over. Paul and I have spent thousands of countless minutes and hours getting into the weeds on this stuff. So we'll try to give our best opinion and best guidance as to where things are headed. Obviously, there's been a lot of new guidance within the last 24 hours, which we'll cover it in depth. And again, leave plenty of time for Q&A, as well as give some updates on the Main Street lending program, which I think, based on the most recent changes, is somewhat more attractive for folks. So with that, we'll go ahead and get started. Imani, next slide, please. So if you go ahead and put up the whole slide, that would be great. So there was a lot of consternation on April 30th when Secretary Mnuchin came out that the quote there at the top, that makes this loan request necessary. Everybody focused on that word necessary. Obviously, the blowback related to the public companies and everything. Yesterday, the SBA updated that guidance, essentially punting on this issue, as Paul likes to say, which I agree with. So anybody that had a PPP loan under $2 million, as you can see there, the quote from the SBA, you're deemed to have made this certification and loan request in good faith. So essentially, you've gotten a free pass there. Now, that doesn't mean, obviously, you should go and do things that aren't permitted under the program, things like that. But again, if you adhere to the spirit of the program and do things the right way and track your costs and expenses accordingly and report that back to the bank, you'll be fine. For those in excess of $2 million, the threat of prosecution and jail and all that has been abated. However, that doesn't mean, again, that you should ignore the process here. And we'll talk about that a little bit. In essence, we want to cover some risk mitigation techniques and some things that you should do to prepare for the fact that you may be audited, and certainly according to the guidance that we have, there is going to be some type of review for that. So we want folks to be prepared, and we'll go over that. But I think overall, the feeling here is that, because of the lessening of demand in round 2, and most of the blowback from the large public entities has gone by the wayside. People know that the folks that applied and have these PPP loans did so for the right reasons, did so in the correct spirit of the program, and so the penalties are less severe than was originally feared. Would you agree with that, Paul?
No, I agree. I was going to jump in here real quick. I think both of us feel very vindicated in terms of our frustration. It really felt like the SBA was moving the goalposts in terms of the guidance that was out there, and then to come in with the threat of criminal prosecution because somebody may have applied in bad faith in the face of an economic crisis of, it's certainly the worst economic crisis of my lifetime. It surpasses 2008, 2009 for sure. There was no way they were going to make any of these. They were never going to be able to prove that people applied in bad faith because the standard was so vague anyway. But it created this huge cloud of uncertainty for all of our clients. You and I both had countless conversations with clients, and many of them, unfortunately, decided it wasn't worth the risk. And mostly it was reputational risk, and certainly the threat of criminal prosecution. Nobody likes the thought of getting put in an orange jumpsuit. I mean, that really scared people. And so they just returned the money. And so now at the 11th hour, we're gonna say, no, you know what, it's okay.
Right.
We're gonna punt on this issue. And so it's frustrating, but at the same time, for those of our clients that stuck it out and kind of hopefully followed our advice and let's just let the process work itself out, they no longer have anything to worry about. Obviously, the vast majority of our clients have loans under 2 million, so now they're fine. They're deemed necessary. This issue completely goes away for them. And for those over 2 million, like you say, you will get into some of the best practices in terms of how you document your need. But I think for all intents and purposes, that issue goes away as well. And in terms of reputational risk, I sent an email out to the firm this morning after thinking about this overnight. And I do think most of the reputational risk, because there's folks that apply for these loans, it will become public record at some point. And so a lot of firms, larger firms especially, were concerned about the fact that they might have crowded out, the fact that they applied might have crowded out smaller entities from getting a loan. Well, as you mentioned before, the demand for these loans has dramatically decreased in round 2. In fact, banks are now reaching out, trying to give the money away at this point. So I don't think that the reputational risk, if there's any that remains out there, is also dramatically reduced. So if you're one of those that have stuck it out this far with any size loan, I would say this issue pretty much goes away. And funnily enough, this morning I jumped on the computer and I saw late last night the SBA put out the latest FAQ. It's right there at the bottom of the screen. They moved the safe harbor date to return the PP funds from today, which was the deadline, which is why we scheduled our webinar for today, frankly.
Right.
They bumped it out to May 18th. And I can't think of many circumstances, maybe we'll get some in the Q&A today, but I can't think of many circumstances where it would be to the benefit of the employer to return the money at this point, given the guidance that we got.
Absolutely.
So,
and as you say, that the only penalty really for those over 2 million is that they come back and say, well, you're not eligible for forgiveness and you have to repay the funds. So why repay it now when the worst penalty is you've got to repay it later, perhaps?
Yeah, and interestingly enough, in that FAQ 46, where they talk about that, they don't even talk about paying interest.
Right.
So they talk about just paying the loan back. So now it becomes a tax. Now, maybe we'll get subsequent guidance because it seems like guidance comes out on a daily basis. But so far, it's just repay the loan, period.
Yep. Imani, next slide, please. And you can put up the whole. So, there we go. So we do want to cover briefly, though, some of the lessons from the TARP program. Paul referenced the Great Recession, 11, 12 years ago. This will be run very similarly by the government. The TARP program had an inspector general, the right to conduct audits, which actually, amazingly enough, that inspector general is still active, believe it or not. There is no statute of limitations, to my knowledge, with this program, nor was there with TARP. So even though, for instance, you might repay the loan if you have one, or if the loan is entirely forgiven, it goes away certainly in 2 years. That's the maximum repayment at this point. Be prepared that there could be a review well beyond that time. That's what I mean by the long tail there. So we're going to focus on some risk mitigation techniques and what you can do to build that file. I tell people, make sure that you are prepared as if a CPA firm like ourselves or anybody is coming in to do an audit. So have all of your documents prepared. By that we want, income statements, balance sheets, track revenues, expenses, cash flow, liquidity. Do some budgeting, do some modeling before and after. Look at your cash burn, AR, AP impact. Are you concerned about collections? Are you concerned about certain customers or contracts and what has been impacted? Those are very, very important. Monty, if you could switch to my screen real quick, I'll give just a brief view here of a great cash flow model that I've had clients use for many years. So for example, you can quickly create a spreadsheet or within your own accounting system just to do a rolling cash burn model. And what I would say is have this kind of thing prepared, pre-crisis, so you can go back and this is what our projection was sort of pre-crisis. Here's what kind of a worst case is now post-crisis. You can focus on the cash burn and those types of things. Do some different impactful modeling with regard to certain expenses and revenues, things like that. So you may want to have a couple of different scenarios, maybe a optimistic case, pessimistic case, that kind of thing. These are very useful. Yes.
Can you make that a little bit larger on your screen? It's pretty hard.
Sorry.
I think everybody can kind of get a feel for it, but it's still a little bit.
Yep.
Yeah, there you go.
So again, just track this kind of, you're all sophisticated folks out there, you can do this kind of cash flow modeling, but the point is try to do it, create a model that was sort of pre-crisis and in terms of what you were looking at based on your budget or prior year financials, and then now do one post-crisis. So Monty, you can go back to the presentation.
My only comment would be, Doug, that I'm going to guess, as you said, I'm sure we're talking to a sophisticated group. I know at Rea Associates, we were doing this kind of forecasting, cash flow forecasting, having conversations with clients across the board, larger clients, smaller clients, clients in different industries, trying to figure out what's going to be the future impact of our cash flow. So any business that understands how their business works, understood the risk that this economic crisis presented. So it's just formalizing that analysis. That spreadsheet does a great job with that.
And again, it's kind of tracking year over year results, so you can compare, March of 18 and March of 19 to March of 20, April, and so on. You want to have those kind of comparisons in a file prepared as if you will be reviewed or audited at some point. Likewise, meeting minutes, write some memos to the file as to your thought process or management meetings that you had, or perhaps board meeting, advisory board, any of those types of things, what your thought process was as you applied and you went into this, what you were worried about, what you were concerned about, the impacts to your business, all those types of documents. I want to quickly show one other example. I routed this to a number of construction clients earlier this week. Monty, can you flip back real briefly? So if we're looking here, this was a letter that actually Travelers Surety provided to their clients, which I thought was a great service Particularly, you can read point 2 here. Because we got a lot of comments from folks. Well, I have adequate liquidity. I have a line of credit. I don't have any drawn, or I don't have much drawn. I have adequate cash in the bank. How can I prove this necessity? And again, as Paul and I alluded to in the opening, I think there are so many unknowns and so much risk here, as people know, that it's not that difficult to really document the concern and the impact that it could potentially have on your liquidity and how quickly that can change. And again, here in point 2, what Travelers was indicating is that, look, just because somebody had a line of credit, that doesn't mean that they were okay and that, this PPP loan should not have been permitted. So I think this is the kind of thing you can also solicit from third-party advisors in some case to assist with that process. They make a number of great points throughout this, and I'm happy to share this. We do have permission to do that. So if any of you contact me afterwards if you didn't have it. But I love this summary here. One last point on this. We view the maximization of capital and liquidity, including appropriate funding obtained from the PPP, as important to guard against these unknown risks. And I think that is just a great summation statement of really what most everybody felt and continues to feel through this process. So that kind of thing is entirely appropriate and useful. Yeah.
So that was a very eloquent analysis of kind of the justification of the necessity for the PPP loan in the face of having a lot, open lines of credit and cash in the bank. What I quickly kind of figured out in conversations with clients, and I asked this one question, it kind of cuts to the heart of the matter, and that is, if you had not applied for this PPP loan, would you have laid people off?
Great point.
Because it makes no difference how much money you have in the bank or how big your line of credit is. Mm-hmm. If your revenues are 50%, 60%, 75% reduced, are you really going to maintain a payroll? I mean, it makes no sense. You would conserve your assets, right? You would cut costs, and payroll is one of the biggest. You would cut costs, and the purpose of the program, it's right in the name, Paycheck Protection Program, was to get money from the federal government to employees as quickly as possible. And it was obviously the conduit was employers, but this idea that if you had cash in the bank or an open line of credit, and you were supposed to use that first before you applied for the PPP loan program, is just absolutely absurd. So, and I can tell you, in every case, whenever I asked that question, it was like, well, of course we'd have laid people off. We're not stupid. Yeah. I'm like, well, then you're fine. You're fine.
And I think that's a great point. And the other thing to remember here too is that, don't just focus on the near term. We've gotten a lot of calls from clients and prospects alike. Well, my business has actually been okay still through this period, or even increased in some cases. That doesn't mean you weren't justified with the PPP, because as we know, again, talking about that long tail, for example, in construction, it tends to be a little lagging. So you got to think about the impact 3 months, 6 months, 9 months next year as well. So, it's not all about necessarily this April, May, June timeframe. So keep that in mind.
And the fact that time was of the essence, right? We were told by the SBA at the beginning of the program that it's first come, first serve. So any one in their right mind wasn't going to put off applying for the program until they actually needed the money 3 months from now, because it probably wasn't going to be there.
Yeah. Well, Monty, let's get back, and Paul, you can get into some of the other current issues and kind of FAQs that we've been dealing with here. We'll get back to the slides, please. Go on to the next slide.
So these slides I prepared, and really it's just no particular order, frankly. They were talking points really for Doug and me to start a discussion. But the first bullet point there is and we still have this uncertainty out there, it hasn't been addressed, is really the basis of accounting for that 8-week measurement period. And we get this question all the time, and it comes in a lot of different forms. But the crux of the matter is the CARES Act says in describing what costs are covered in the 8-week period in terms of forgiveness, the sum of the following costs incurred and payments made. So is it any costs incurred and any payments made, or must every cost be incurred and paid? And we don't have much guide. We don't have any guidance on this at this point. So we've tried to take kind of a middle of the road approach with our clients, and when we've identified things that are maybe aggressive, we've told clients to put those on your spreadsheet, set them aside, don't forget about them. Yeah, and if we don't get additional guidance on this stuff, I'm going to tell you, be aggressive, include it, put it down there. Let the bank tell you can't do it. Let them figure out, where the guidance is that prohibits including this stuff, because with many of these expenses, it just isn't clear. There are very few qualifications. For example, and I'll just throw this out, and we have this on another slide, but with respect to retirement plan contributions, that's a very common question.
Yep.
Many of our clients have cash balance plans or defined benefit plans in addition to 401k plans where they may be making large profit sharing contributions. And the question is, well, I haven't made my cash balance plan contribution for the year for 2019 yet. Can I make that during this 8-week period and include that? And yeah, I think based on the guidance we have right now, that flies.
Yeah.
May we get some guidance that says, no, that really wasn't what we were talking about. That's not what we meant when we said retirement plan costs. We meant something that had to be incurred during that 8-week period and paid during that 8-week period, both. So set that aside, but barring any future guidance on that stuff, it's good to know about this stuff, and we would say include it, because there's no reason not to. And if it helps you get to 100% forgiveness on your loan, that's a great thing. So.
ESOP contribution as well. That's another one we get a lot of questions about. And would fall into the same category. But
for sure,
that's great.
For sure,
great guidance.
So that's unfortunately don't have much that we can add at that point. But what I'm basically saying on the cash basis is the important part to me is, if you're thinking about the spirit of the law, the idea was to get this money out to people as quickly as possible. So I think there is going to be an emphasis on paying the money during the 8-week period. What I'm a little less sure of is the costs incurred part. And so I would say for sure, if you're a business that was putting off making some payments, whether they're mortgage payments or whatever, from February and March, and now you have the funds because you've got the PPP money and you can go ahead and get caught up on some of that stuff, I would say that stuff is fair game. I think Doug would agree with that. Mm-hmm. When it comes to prepaying rents, prepaying utilities, prepaying mortgage payments, just to use up the money, I think you're starting to get outside of the spirit of the law, and that's a more aggressive interpretation. I would say at this point, just let's keep that on the table, but let's wait for additional guidance. And I think I've been telling clients for a long time that I can't wait for the actual application for forgiveness to be published, because I think that will answer a lot of these questions, even more so than hundreds of FAQs.
And be prepared for another webcast from us when that does come out. That's to me, I agree with you. That's the one remaining piece where we'll get some definition around some of these things. And to your point, if we don't at that time, be aggressive. So we'll see, more to come.
So a lot of other questions. Next bullet point there is payroll costs for self-employed. A lot of clients, sole proprietors, single member LLCs, or partners, just because they're not W-2 payroll folks, had a lot of questions regarding, well, how do I document for purposes of forgiveness payments to myself, since I'm not on the payroll and my name isn't going to be in the payroll register. So we got guidance, pretty specific guidance a while ago. I don't know if this is necessarily the hottest issue at this point, but I still get an occasional question from clients on this. Basically, you're going to be looking at your 2019 self-employment or your net profits from self-employment. If that number was above 100,000, then you're going to have to limit it to 100,000 and then specifically prorate it for the 8-week period. So it's, when you do the math, it's 15,385. It's the same limit as an employee would have. In terms of documenting the spend, I think you just have to document the draw, if you call it a draw, guaranteed payment, whatever it is, during that 8-week period to yourself. But a lot of clients have asked, well, can I use 2020 net profits? Maybe they were higher. But the answer is no. You're limited to your 2019 net profits. So if your 2019 net profits as a sole proprietor were 50,000, you're limited to 50,000 times 8 divided by 52 in terms of the compensation for yourself and for any partners in terms of their allocable share based on the K1. So I think that's been pretty much put to bed, but I just wanted to address that issue in case there were any in the audience today that were still wrestling with that. Healthcare benefits for the self-insured. I've been getting a lot of questions on this. A lot of our clients are self-insured. Rea Associates self-insures for our healthcare benefits instead of paying insurance premiums to an insurance company. So a lot of clients were concerned that they could only include the claims, for example. And my take is, again, there's been absolutely no guidance and there are no qualifications or definition of healthcare benefits. So my take is whatever costs that you're incurring to provide healthcare benefits, I think are fair game. So claims would be included in that. Your administrative fee that you pay to the company, the TPA that processes your claims, that should be included. Stop loss insurance is a big part of self-employed or self-insured plans. So I think that should be included as well. Any payments during the 8-week period for that, if you have any. And then any other, we have a lot of other vendors associated with our plan that have costs really to manage the claims. And so I would include those as well. I don't think I can list them all, but there are some potentially in addition to the ones I've specifically described. So if you're self-insured, then I would say any of those expenses that are used to provide your healthcare benefits would be fair game. So any other thoughts on that, Doug?
I totally agree. Again, there wasn't a lot of clarification, but we want to make sure that folks that are self-insured certainly capture all of those costs.
Yeah. And then we already kind of alluded to the retirement benefits. What we're telling clients is there was no qualification on the definition of retirement benefits. I think you do have to reference back to what basis of accounting are we using here for this period. Certainly any match during the 8-week period or any match that you had accrued and hadn't paid yet, I think all of that's fair game. Same with safe harbor contributions to a 401k. Where I think it gets a little grayer is making your full-blown 2019 profit sharing or cash balance contribution during that 8-week period. But because it's been incurred and you would be paying it during the 8-week period, I think it's possible that it would apply. I think it gets a little grayer yet if you're talking about trying to prepay some of those costs for 2020. Again, I think prepayments have only been limited in terms of mortgage interest payments, specifically in the CARES Act, where they limit prepayments of that. So presumably prepayments, since they weren't specifically prohibited for any other expenses, may be allowed. But I do think it's getting a little further removed. The other problem I have with making prepayments on large profit sharing contributions or cash balance contributions for 2020 in particular couple things. You're probably going to have to estimate those since you don't have all the data to make those calculations anyway, since 2020 isn't over. But the biggest problem for me is those large contributions are qualitatively different than a match or safe harbor contribution that's kind of ratable across all the employees. Many of the allocations that we do for clients, profit sharing allocations that we do for clients, are tilted toward the highly compensated. Not illegally so, but we are obviously playing within the rules, but the rules do permit quite a bit of skewing of the benefits to the highly compensated and the ownership group. So I think all of that is a little problematic in my mind, and may lead to some future guidance that limits those. So set those aside. Let's see what kind of guidance we get before your 8-week period expires. If we haven't gotten any guidance, like I said before, I think be aggressive with it. Let them tell you can't do it. So that's, any other thoughts on that, Doug?
No, I totally agree.
I think we've beaten that one up. Hopefully everybody gets right on that. Next slide. So this next one is just kind of came up within the last week. I got this question from clients as well as other professionals, attorneys that we work with. And that is, if there's a concern out there, again, because the law wasn't drafted very well, and neither has a lot of the guidance, frankly. There's a concern out there that if you don't hit 75% of the total loan proceeds in terms of cost during the 8-week period, that none of it will be forgiven. And frankly, I don't think that's the way it was meant to be. I understand where that's coming from if you just read certain sections of the law, but I think if you read the law and the guidance kind of in totality, what they're getting at is, we really want you to use at least 75% of this loan proceeds for payroll. We'd really like you to do that during this 8-week period so we can push this money out to the country as quickly as we possibly can. But if you can't, that's okay. Just after the 8-week period, continue to use that money for payroll. We're going to give you a forgiveness. We're only going to give you forgiveness on those funds that you expend during the 8-week period. I think that's where we're ultimately going to end up. I think that's kind of the spirit of the law. I've referenced that before because I think that's helpful in trying to figure out where the guidance is going to lead us. And we've been very successful in terms of, trying to predict where the guidance was going to go. A lot of this guidance that we've gotten has been kind of as we expected. So hopefully the remaining guidance that we get will kind of also follow along the spirit of the law. I don't think it is all or nothing. I don't think there is anything other than, if you got a loan for more than $2 million and somebody comes to the conclusion that it wasn't necessary, then you're going to have to pay it back.
Right.
That will have to be paid back in full. But I think barring that, I think any payroll costs, mortgage interest, rents, utilities that you can document that you paid during that 8-week period, that will be forgiven. I don't think you're going to need to get to that 75% of total loan proceeds spent on payroll costs during the 8-week period before any of it gets forgiven. I don't think the bar is going to be that high.
Yeah.
You want to jump in on the headcount requirement discussion?
Sure. There's still a lot of confusion related to the FTE calcs. There's a couple of different options that you had in order to determine your baseline. I don't necessarily want to get down into the weeds on that, but make sure you're doing your homework and tracking that properly. Our best guidance related to FTE as well is that an FTE is 30 hours per week. There is no official guidance along those lines, but that is what is defined in the Affordable Care Act, which as of now still stands. So that is the best guidance that we have in terms of calculating an FTE. Don't try to game the system. We've gotten a lot of folks saying, well, if I have somebody work 60 hours, is that 2 FTEs? No, don't go that route. So anybody 30 hours or above is 1, anybody under 30 It's a fraction of that. Make sure you're looking at your baseline periods. Our forgiveness template allows you to kind of optimize. You're going to choose whichever baseline period is most beneficial, and then track your FTEs over this 8-week covered measurement period as it's defined, and then do the comparison and see if there's any reduction warranted based on that. So again, feel free to reach out with any questions. I would tell you that in terms of calculating those FTE, we're looking at what's your average FTE over the period. So there are a number of ways you can interpret that as well, but try to be, again, our best guidance there is be consistent with what you're doing, and don't try to necessarily game the system, if that makes sense. And
I think the easiest thing to do is just look at each payroll period, right? Yep. Figure out. I think a lot of the payroll providers are coming up with reports that help with this calculation and can provide an FTE number for each payroll period, and then just take the average for the 8-week period and compare that to the pre-crisis comparison period. Yep. And whatever that percentage is, you multiply that by your potential forgiveness. And if you were at 100%, you won't have any reduction. If you were at 80%, then you'll have a 20% reduction in that forgiveness amount. So pretty straightforward. We'll deal with the June 30th issue, restoring headcount a little bit later. Go ahead, Doug.
No, that's all right. Do you want to get into that June 30th? I want to make sure, I'm just looking at the time here, we get into leaving some Q&A time, so we can jump to that if you'd like. Sure.
So June 30th has yet another measurement period, unfortunately. So what the law says there is you're going to take a look at any reductions in headcount that you had from February 15th to April 26th. Don't ask me why there's yet another period to look at. It doesn't make much sense. But if you restore the headcount that's reduced during that time period, and you're going to be comparing the reductions for that time period back to your headcount as of February 15th. If you restore your headcount prior to June 30th, is the way the law reads right now, then you don't have to do any reductions for headcount. And the same would be true if you restore salaries and wages, which we haven't really talked about yet, but if you were to restore salaries and wages, which may have been reduced by 25% during that time frame as well, then you don't need to do any of those reductions. The odd thing is the reductions are based on the 8-week measurement period comparing to a pre-crisis period, and now we have yet another period that we're looking at. And if you restore the decreases in headcount or wages during this third period, then you don't have to do the reductions that we calculate with these other periods. So it's very confusing.
And that June 30th is undefined. I mean, is it one day in time? Is it a period leading up to that?
It is. And I, where we were at from the very beginning was, well, look, if you put off until June 30th to bring everybody back, how are you going to spend all the money anyway? So You're not going to get much forgiveness anyway. So we've been encouraging folks to the extent they can bring people back, they should do that. There are a lot of businesses that are completely shut down, and it's difficult for them to bring them back. A lot of other issues related to that. But spend as much of the money on payroll as you possibly can if you want to get this forgiveness. There may be some very good business reasons where you're not concerned about the forgiveness, and you just need the money just to keep the business open, and you're going to turn it into a loan. You had every intention of using it as a loan for the next 2 years, and that's okay too. That's okay too.
Imani, let's move to the next slide and talk a little bit maybe about some of the other costs, rent, utilities, some of those things as well.
We talked about the June 30th restoration. The second bullet point there, what if we are shut down, laid most people off? And I just kind of alluded to that discussion as well. There may be, I'm glad I put a reminder there, because we have heard some discussion of future legislation and future relief acts or bills or laws that will kind of make this 8-week period a little more flexible. maybe extend out the June 30th deadline, relax the 75% payroll cost requirement. Not sure what's coming down. I'm not going to certainly make any predictions in terms of what might be passed in the future, but there may be some flexibility there.
I think that's an important point, that last one there, Paul, because that 75% requirement, that's an SBA interpretation.
Yes.
It's not specifically laid out within the CARES Act. So there's some flexibility to do that pretty quickly without necessarily passing legislation to change that. The SBA can come out and just say, well, here's what we really meant.
I have read times. The Inspector General for the SBA has already come out and said, hey, I think maybe SBA might have overstepped their bounds in terms of interpreting this 75% requirement, because it's not written in the CARES Act anywhere.
Yep.
So,
next slide, please, Imani. So yeah, these are some of the things we want to touch on here as well, that we get a lot of questions related to this. There was some initial confusion around what type of interest on which type of debt would be considered. There's still some mixed signals on this. Everything subsequent that we've seen refers to occupancy costs and trying to reference interest strictly on a mortgage obligation. That doesn't mean the others aren't allowed at this point. There's, again, no prohibition or definition of that. Again, as Paul alluded to earlier with some of the other provisions, we're just cautioning people on that at this point. So again, track that, set it aside.
The concern is that the example of the vehicle was used with a self-employed person, with maybe one vehicle, one truck that they're using in their business, or maybe a couple. The problem is you could expand this to very large businesses with fleets of vehicles, and I'm not sure I would want to go there yet. But they did use examples of mortgage obligations on real and personal property, and the examples used were a warehouse and a business vehicle. But it was in an example that was meant for a sole proprietor. So I'm not sure I want to take that example and blow that out to every possible type of business entity of every size. I do think, I agree with you, Doug. I think the spirit of the law was occupancy costs, not equipment costs.
Right.
But we'll see.
We'll see, exactly. So again, as we've talked about over and over, track that stuff, and it perhaps will be allowed. Business rent payments, we get a lot of questions about this too, as Paul, as we've noted there on the slide. Self-rental is okay, but again, be reasonable and consistent. So make sure you have a lease in place. If there was no lease in place, don't try to all of a sudden jack up the rent. Be consistent with what you've paid in the past. Course of dealing and history is important there. So make sure you can document and justify what you've been doing there. But obviously we have a lot of clients that have, their own facilities owned in a separate LLC outside that. That's perfectly okay to pay that rent and include that, as long, again, as you're reasonable and consistent.
I put in parentheses there after business rent payments, warehouse or vehicle. It was the exact same example, exact same guidance, just a different expense category. They referenced, instead of owning the warehouse, if you were renting the warehouse, or if you were leasing the vehicle instead of making debt payments on a vehicle, they would be included. I'm not sure I want to go, if you're a trucking company, every one of your trucks, that you lease or that you have a debt payment on is going to be included. I'm not sure that's what they meant. But, if we don't get any guidance, it may be fair game. So put it on your sheet. Let's not lose track of it as an idea. And before your 8-week period expires, if you want to make some of those payments, if you haven't already, make them, and let's see what the actual application shows.
And the best practice here, again, as you get towards the end, make sure you're communicating with your CPA and your banker, and try to get everybody together so that you're on the same page in terms of what you're doing what your thinking is and all of that, because ultimately that application has to go back to the bank, and then they have 60 days to essentially opine on that and submit that to the SBA. So keep that in mind throughout this process. Utilities, the big one we get here is transportation. Again, that's totally undefined at this point. So, hard to say what transportation costs are. Again, we're trying to be somewhat conservative there. If you're a contractor, and again, you've got a fleet of vehicles and crews that are going out to job sites, does that all count? What do they mean there? So again, best to track that and remains to be seen on that front.
Yeah, all of those things listed there are in actual guidance. So that gas for business vehicles, again, that was pulled from a sole proprietor example, but we have no other guidance. So I don't know what they were talking about with transportation, other than that one little description there.
Yep.
The other question we got a lot was, is internet included? I think internet is pretty much a utility for everybody at this point. It's hard to do business without it. And it was actually listed in the act or in the guidance, as well as phones. If you have a cell phone expense within your business, then I would include that as well.
Absolutely. Next slide, please, Imani. Do we want to, we're getting up against 50, we've covered a lot of these, except for the deductibility of payments. Now, the issue there is that in terms of the tax application here, any forgiven loan amount, the IRS has said will not be subject to income tax. In other words, that won't be taxable income, that forgiven loan amount, which is obviously not the norm, but that was great news. However, then a few weeks ago, they also said that the related expenses will also not be deductible. So it kind of makes this thing tax neutral. Obviously, that's a significant impact and change. Now, there's been some push to perhaps change that. As of now, that is not the case. So the income from the forgiven loan will not be taxable income. However, again, those related expenses will not be deductible. That's where we stand at this point.
Yeah, and the IRS has made that clear that they're interpreting Code Section 265 to not allow the related expenses to be deductible. So that'll have to change legislatively. But there has been quite a bit of push in Congress, both on the Democratic side and the Republican side, to that they all believe that the congressional intent was to have this big carrot for pushing this money out as quickly as possible, and that if they were forgiven, that there would be a tax break as well. So anyway, we'll see.
You want to touch on that last point real quickly, Paul? That guidance just came out late yesterday.
I wasn't surprised to see it. It's funny, we were giving the guidance to be aggressive. This goes all the way back to the application process with partnerships. I actually had a interesting conversation, very good conversation with an attorney who was going through the process of applying for a PPP loan for their firm, and their strict interpretation of the law, and she was absolutely correct, was that any partner's income shouldn't be included in payroll costs. It wasn't covered anywhere. It was basically an omission. Well, we kind of took the position that was pretty much the same as a sole proprietor, only a bunch of sole proprietors working together. I mean, we just couldn't believe that it was the intent of Congress to include sole proprietors, include employees, and for some reason keep partners out of this, partner compensation out of this. So we were aggressive in advising clients to include that. So I don't know that many of our clients excluded it, but some did. And subsequent guidance came out that basically said, no, we really did mean that you should include partnership income as well, up to 100,000, just like for sole proprietors. So all this is saying is, if you relied on that previous guidance and you reduced your payroll cost, your average payroll cost for partner comp, then here's an opportunity to now reapply. And I think this also gets at, we've got money, we're trying to get rid of this money. We're happy to give you some more money if you want it now. So this came out late last night. So I don't know how many people will apply for it, but it's out there. The other one is seasonal employers. They kind of moved the goalposts on that one along the way as well, created additional flexibility in terms of what is the optimum. At what point during the year does a seasonal employer have their biggest cost, payroll cost, and they allow you to use that 12-week period. And so if it would be beneficial for you to go back and redo your application using this different payroll period for calculating payroll costs, you're allowed to do that and increase your loan amount.
Yeah.
So that's all that is.
So bankers have fun with amending some of those that already weren't
Exactly.
in place. Good luck.
Exactly.
Amani, let's maybe just briefly cover the Main Street lending program for just 2 minutes or so, and then we'll take Q&A. You can go ahead and put up the whole slide here. And Paul and I are happy to, previous slide there. Yeah. Paul and I are happy to stay over a bit for some Q&A, but do want to touch on this. They updated the term sheet related to the Main Street lending program a couple of weeks ago. There are actually 3 different loan types under that program. What we've outlined here is really the most attractive of the 3, we think. Again, some of the points here, unlike the PPP, this is a traditional underwriting process with the bank because the bank will hold 15% of this loan. That said, it still, I think, is very attractive given the changes. I've talked to a number of banks on this. I think you're going to have a lot of the major banks expect to go live, maybe not late next week, perhaps, but certainly the following. That's their expectation at this point. However, interestingly, there are some banks that are going to pass on this program. So, it's not going to be quite the same fire drill as the PPP. Again, because I think there's adequate funding in this program and it does have to go through a traditional underwriting process. It's not just a couple of page application and then off to the SBA. They did expand the usability of it. In essence, anybody up to 15,000 employees or 5 billion in revenue is eligible. So it's anybody and everybody. The minimum loan size is $500,000. And how that eligible loan amount is determined is 6 times your 2019 EBITDA less existing debt plus any committed and undrawn debt. So I think originally that was it was 4 times in there, if I recall correctly.
Yeah, and the minimum loan size was $1 million, so they dropped the loan size. Yeah.
So if you look at this, I mean, if you think about it, if you had 83,000 in EBITDA last year, you're eligible. So I would urge everybody to strongly take a look at this for a different reason than the PPP. This is a longer term source of capital, which still can be very attractive. It's got a 4-year maturity on it, no P&I the first year, only 15% principal in years 2 and 3, and then 70% in year 4. It's an attractive rate of LIBOR plus 300, which right now would be about 3.4%. There's some other restrictions there. We won't necessarily get down in the weeds, but they relaxed some of the things. Initially, you couldn't have dividends or distributions. Now they're saying, yep, you can do that if they're to pay taxes, and reasonable efforts to maintain payroll, things like that. There are some exec comp limits in it. If you were over 425K, there's some mundane rules there. Essentially, you can't give yourself a raise during the period that you have this, and even 1 year after. So some things to look out for, but I think still for many businesses, this can be a cheap and attractive source of capital if you're looking to plan a little more long term. So I don't know if you had anything else on that, Paul.
No, I agree with all those comments.
Let's get into the Q&A. So Imani, can we go ahead and do some Q&A?
Sure. So like Doug said, we'll be going over about 10 minutes or so, and any questions we don't get to, we'll be sure to reach out to you because we did get a lot. So the first one we have here, it's kind of like a 2-part question. It's what is the beginning and ending date of the 8-week period, and will the time frame be extended past 8 weeks to document expenses?
So the 8-week period begins exactly on the date that you receive the funds, exactly on the date that they're deposited to your bank account. That is the beginning of the quote unquote 8-week covered measurement period. It runs for exactly 8 weeks from that date. They're not business days or anything like that. It's calendar 8 weeks. In terms of an extension, that has been talked about. Paul, you might have some more guidance on that. I know that's been a lot more in the news here the past several days and over the past week, and there's some talk they may extend that.
Yeah, I mean, the talk comes from, it's very, very practical, pragmatic issues with that 8-week period. Most of the businesses that were most heavily impacted by the crisis so far were restaurants, hotels, businesses that cater to that industry. You know, there's just no way they're going to get their, I mean, a lot of the states are still shut down. These businesses can't be, except for maybe some carry out type functions. There's no dine in. So the vast majority of their employees they're not working, and they won't be bringing them back anytime soon. So from a very practical standpoint, it's very tough to comply with this 8-week period. So there's a considerable amount of pressure being applied to fix this and to create some flexibility. We mentioned this earlier during our slide presentation, to either stretch out the 8-week period or create some other type of flexibility with the headcount requirement, things like that, or reducing the 75% payroll cost requirement. So that some of these businesses that have been heavily impacted and still, you know, are nowhere near having their people back to full workforce can still take advantage of the loan forgiveness provisions. But right now, it's that 8-week period is the 8-week period. Yep. It is strictly 8 weeks, and the only flexibility that you ever had in terms of when that 8-week period started was prior to receiving the loan proceeds. If you told the bank, hold on to it for up to 10 days, then you could kind of delay when that 8-week period started. But if you've already received your money, your 8-week clock is ticking.
And in terms of application for forgiveness, most all the loan documents that I've seen related to PPP, you have 30 days after the end of that 8-week period to apply to the bank for that forgiveness, and then they typically have 60 days to decide.
We don't even have an application at this point, so
right.
But I'm sure there'll be one.
Yeah, hopefully.
Okay, and another question kind of off of that, it says, will PPP expense that needs spent during the 8-week period, is that based off of the 2019 profit and not 2020 profit?
I missed that. Is that in reference to self-employment earning? Is that a sole proprietor or a partnership? Can you read
Sure. It says PPP expense that needs spent during the 8-week period, is that based on the 2019 profit and not the 2020 profit? It says SDHC business.
SBHC. I don't know.
Not too sure about that one. We can always get back to it.
Yeah, let's go to the next question. Sorry, I don't.
So it says, I know you need to repay the funds if you lay off employees, but what if an employee voluntarily resigns to take another job?
Yeah, this is a common question, and unfortunately, we don't have any guidance at this point. I think there does need to be some flexibility afforded here. Many businesses have normal attrition, people coming and going, having nothing to do with the coronavirus crisis. People retire, so they did build in some language into the CARES Act that talks about a de minimis amount of change in headcount being disregarded. But that isn't defined anywhere. De minimis for a large company is different than de minimis for a small company. So I don't know how they're going to define that, but it seems to me only fair that you should be able to document that if somebody retired or left to take a different position with a different company and the fact that they're no longer on payroll isn't because you laid them off. you should be able to document that and not have that count against you. Is that specifically written anywhere right now? No, it's not. But I'm sympathetic with businesses that are in that position.
Yeah, I would agree. Yeah, I concur
so
with that.
We'll see. Definitely document those folks. Hopefully you have all that in writing, letter of resignation or whatever, because you're going to need it. No doubt you'll need it, but that's the best we can do on that one right now.
Next question we have here is, are we allowed to give bonuses to employees? In this specific scenario, it says we have some employees going above and beyond their regular duties, plus we have cut out their overtime to 0, and that is lower than our comparable payroll from last year. So we want to give our employees extra money to make up for that gap. Is that allowable?
Yeah, our guidance on that is yes, again, but be reasonable and document what you're doing there. But we have folks that are giving, hazard pay bonuses, normal raises, obviously those kinds of things, or even, a raise during this temporary period. Again, none of that is specifically disallowed, but we would caution, try not to be egregious in anything you're doing there. Because what they're going to look out for are things where, again, you're trying to game the system. And if you've, say, reduce some head count and try to make up for that with significantly increased wages to try to, again, game those calculations, I think that's where you want to be cautious. But anything that's reasonable like that, given the circumstances, I think is perfectly fine. Would you agree, Paul? I
do. The only thing that we've also been, I just want to remind you, we've been telling clients, be aware of that 15,385 cap. Mm-hmm. So you can't go over that. You can go over it, but it won't be counted towards forgiveness.
Right.
So, that, and if you annualize that, that's that $100,000 limit. So if you've got folks that, have a base of at least 100,000, giving them a bonus isn't going to do you a bit of good in terms of forgiveness. So just be aware of that. But I would say I can't imagine many instances that would be egregious for rank and file type employees that usually make substantially less than 100,000. You've got a lot of room to work with there. And frankly, the spirit of the law was to push as much out to these folks as possible. And you don't know. I mean, none of us know how long this is going to last. You may end up having to lay these folks off, and if you end up giving them an extra $1,000 or $2,000 to put in the bank, their bank account to help prepare them for when they are laid off and they go on unemployment, hey, I don't think anybody's going to have any problem with that.
Yeah, totally agree. And again, that $100,000 limit, or that 15,385 during the 8-week period, that only refers to gross comp. So that part of that calculation doesn't include the benefits and other things that you're paying those folks. So keep that in mind as well.
Yep.
Okay, so this next question here is kind of a long one. So if you need me to repeat it, just let me know. It says, before the PPP loan was hatched, I applied for the $10,000 emergency loan. When I filed out the PPP form, one of the questions was, have you received any emergency funds which will reduce the PPP award? I did not have acknowledgement of the emergency funds applications at the time, so I answered no. I received the full amount of my PPP application, and about the same time, $4,000 showed up in my operating account with no communications from the SBA at the time of application or award. Do we just send the $4K back? If so, where do we send it? What do we use for reference? Obviously, don't want to get in hot water for having the two programs.
I'll jump in on this, and I'm passionate about this. I think you just have to remember the chaos involved with the application process, both on the disaster loan side as well as on the PPP loan side, and the quickness with which the government was trying to act and force what at the time was $350 billion in loan proceeds through banks out to employers through a system that normally processes $25 billion in loans in an entire year, let alone a matter of weeks. So No, I don't think you need to return any of the money. It was very clear from the get-go. You answered the question to the best of your knowledge when you applied for that PPP loan. Our advice to all of our clients at that time was apply for everything that you're eligible for. And frankly, because the disaster loan system was overwhelmed, a lot of those loans or grants got slowed down. The two programs are not mutually exclusive. I think you need to be careful about what you spend the money on, because you do want to prioritize payroll costs, mortgage interest, rents, and utilities for the PPP loan proceeds to maximize your forgiveness. But you can use that EIDL grant on any working capital obligations of the business. Do not send it back. The government wants you to have that money so that you can stay afloat. They do not want you to return that money, and it was never meant to be repaid. No questions, no, it's just here's some money. We hope you stay in business type thing. Again, I do think I guess the last point I want to make is you will be, that EIDL application was an application for the grant as well as for a disaster loan. So you will be, and we've started to see our clients beginning to get additional funds from their EIDL applications. And again, as long as you use those funds, they're not forgivable. It's kind of like the Main Street Lending Program. They're not forgivable, but you have a lot more flexibility in what you spend those dollars on than you do on the PPP loan. So, if you get offered additional funds from SBA through the disaster loan program, in addition to that $4,000 in the case of the question, I think that's something you need to consider heavily. The terms on those disaster loans, it can be payable over 30 years. I don't think most people would want to pay over 30 years, but that just tells you the amount of flexibility that you have, and it's 3.75%. So the rate is attractive as well. Anything else to add there, Doug?
No.
Don't need to return the money.
No. Do you want any impact on forgiveness? Because I know we get that a lot too, EIDL and.
Yeah, I don't think so. I think as long as you use the money for a different purpose, a lot of folks are setting that money aside and they're prioritizing the PPP money initially, or if they are using the EIDL money, they're documenting what they're spending that money on, and it's usually a non-payroll, it could be inventory, other normal payables, whatever, of the business, working capital type requirements. But is there something else that you were getting at there, Doug?
No, just that's a question we get a lot related to.
Yeah, I think what might be confusing folks is there was an opportunity to refinance EIDL loans, but I don't know if any of our clients had actually got approved for those grants or loans prior to receiving their PPP funds. It's possible, I suppose, but there would have been an opportunity in the application process to refinance that EIDL loan. And then you could have used the EIDL loan for payroll purposes and gotten forgiveness on that theoretically. But I haven't run across that fact scenario. It's usually what the questioner asks. That's the normal scenario. Hey, I was applying for all this stuff. I didn't know what I was going to get. And now I've got the EIDL grant and I've got the PPP loan. And now how do I coordinate the two? So.
Yeah, and we'll see. My sort of guess on this is that the EIDL grant will be subtracted from your PPP forgiveness. Again, that's just totally my guess.
It may be on the PPP loan application for forgiveness. Yeah, I agree. There may be some reduction of the forgiveness, but if you didn't use the money for payroll, I don't know. I'm not sure how they're going to handle that.
Yeah, we'll see.
But you definitely don't need to return the money.
Yep. Next question.
Great, and we're going to do about 2 or 3 more small questions here, and anything we don't get to, we'll be sure to reach out to you guys, and we'll also be having this as a recording to send out to you as well. So the next question we have here, we're getting a lot of questions about insurance. So for an example, will monthly cost of insurance for building be considered as an expense? And then also we have one about paying insurance premiums with PPP money.
The building insurance, no, that's not includable to my thinking. You agree with that, Paul?
I agree, unless you got some formula where the building and you're renting a building and you're responsible for the insurance and it's included arguably in the rent for the building. But even that's questionable, I would say. So in general, I would say, right, no, it's not included.
How long will the main, oh, go ahead.
What was there a second part to that question other than insurance? I can't remember.
No, it was just two different examples, kind of asking about insurance, asking about insurance premiums, and then also asking about the rent for the building. I mean, the insurance for the building.
Okay. Yeah, no, I don't think so. The rent, yes. The insurance, no.
How long will the Main Street lending program be available?
As of now, it's going to be open until September 30th. My suspicion is they may extend that a bit, but we've certainly got some runway on that, so I wouldn't be concerned about timing.
Yeah, I wouldn't be concerned about timing either. And it's not even available now. So if you contact your banker, they're not processing these loans. Doug, you had some comments on the Main Street lending when I asked you about it in terms of what your banking contacts were saying. I think you said that not all banks were going to get into that game.
True. It's I know of several that have just decided to pass on it for whatever reason. So it won't be quite as widely available. But I know a lot of the major banks certainly are. And again, I think it's a fairly attractive source of long-term capital for some. So I would highly encourage anybody to at least do your diligence and take a look at it.
Hey, Imani, give us a couple more and then we'll probably wrap it up.
Yep. Here is one. Is there an updated Excel document to help calculate loan forgiveness that you can provide for us?
Yeah, all you need to do is email us and we're happy, either Doug or me, and we'd be happy to share with you ours. Ours has evolved slightly, but we haven't really changed it substantially. We're still waiting on a lot of guidance specific to the forgiveness process. It's really just a place to kind of gather all of your potential expenses so that you don't forget about them, and you can use them on the application for forgiveness. I think over the last few weeks, we've noticed some formula errors and things like that we've corrected. So we're happy to send you our most recent version, but it really hasn't changed substantially.
All right, and here's the last question here. If our fiscal year ends June 30th, does this change the consideration for funding a profit sharing program?
That's probably for me, since I'm in the 401k plan administration world. I don't know that you're going to be, well, it depends on when your 8-week period elapses or ends. I still don't think you're going to have enough time, even with a 6/30 year end, to try and get that pre-funded. I suppose you could try to predict what your annual compensation is for all of your employees and do the allocation that way. You would have more of a leg to stand on, since it's your year end would be closer to your 8-week period. So I haven't told anybody not to include that. So for sure, if you have the ability to do that, working with your TPA to do that calculation, or at least estimate what that'll be, go ahead and do that. I think we are going to get some guidance in terms of whether that's going to be allowable or not, whether it's a calendar year or a fiscal year. So
I would agree. That's too big of an item that they will just to leave it hanging on that one.
Yeah.
Awesome. Thanks, guys. Thank you for joining us for today's webcast, What is Life After Coronavirus? Navigating PPP Forgiveness and Certificate Guidance. Be sure to stay tuned for more guidance on this topic. We hope today's team was able to provide you with some valuable insight that will help you navigate the funding you may need amid this economic uncertainty. If you sign off today and realize that you have additional questions, you're always welcome to reach out to Paul or Doug directly. You can also contact any of our REA team members by checking out the People section of the firm's website at www.reacpa.com. That's REA. Don't forget to watch your inbox for an evaluation survey, access the recording of today's webcast, and more. Thank you guys, and we hope you guys have a wonderful rest of your day.
Thanks, everybody.
Thanks everyone.